Alrighty, so we're rocking and rolling on video number 7 in the series. This is risk management and profitability. We're going to jump right into this. So generally speaking, when you're making trades and talking about risk in general, you shouldn't be risking more than 1% of your account total balance. So if you have a $10,000 account equity, you should be risking around 1% of that, or $100, and then you should be shooting for under that ideally, but you shouldn't be risking more than that. And then just a reminder, we're going to add some nuance to this, and we're going to talk about like changing your position by exposure. So a reminder that the S5FI is the percentage of SPY stocks above their 50-day moving average. So I would say that there's really 3 conditions for the market if you were going to adjust your position sizing by exposure here. So you have favorable, which is when the S5FI is going to be above 50. And then so risk per trade on this is going to be 1 to 2% of account equity, so you could get up into that $200 range if you were so inclined. And then I would say a choppy market, which is going to be between 50 and 25. You're going to be looking at 0.5% to 1% of a total account equity. And then poor, you're looking at anywhere less than 0.5% for total account equity risk. And this is what that would look like on the actual S5FI ticker. So you can see that the majority of time we spend in this range here, we're going to be looking to risk about that 1%, shooting for lower, but no higher than that 1%. And then these areas down here are going to be sort of danger areas. But I will say, when we flush crazy down to the downside, like we did here after like the March and April tariffs, we have a lot of thrust out of this range. So when this starts to pick back up, I would say like around up in here to up here in the top, this is going to be like actually the most favorable condition to trade. It's not going to be, it's a little bit hard to make that super cut and dry. But when we're coming out of the range down in here, you have a lot of thrust to the upside, so this would be very favorable to trade in, and you totally could have traded before you left the danger zone in here and really loaded up. But that's just sort of adding a little bit of extra unnecessary nuance to that. So as far as risk management goes for a per trade basis, there's 3 main types of risk management that I use, and that's going to be free rolling, which is selling a portion of a position to make a trade effectively risk-free. And then I use trailing stop losses, which is selling part or all of a position at the first close under a moving average. And then low of the day stop loss, which is going to be selling part or all of a position on the first lower low when a stock is short-term extended. And we'll take a look at what that means, because that definition is sort of confusing. But so as far as free rolling goes, this is where the real meat and potatoes of risk management comes from. So let's say that you were buying this breakout here, and you decided to buy on this here, and you were going to set your stop loss at the low of this last contraction. So you, to make the prices easy, we're going to look at $100 and $97. So if your entry price is $100 here and your stop loss is $97, you have a $3 range in here. So the formula for risk is going to be your entry minus your exit times your share quantity. This is going to give you the dollar amount that you are risking per trade. So free rolling as a whole is going to be the idea that you are risking, that you are going to sell a portion of your position at a certain price range or a certain level, so that the rest of your position is essentially risk-free because the profit offsets the risk. So what that looks like for this example, if you were going to free roll 1/2 of your position, you would sell half of your position up here at 103, which is going to be 2 times your initial stop loss. So that's 1 and 2. And we'll break this down. So if you bought 100 shares at $100, and then your stop loss is at $97, you have a $10,000 position value, and you're risking $300 on this trade. If you sold half of that position at $103, you would have a $5,000 value of your position, and you would be risking $150, but you would also have $150 of profit, which offsets the risk and brings the effective rolling risk, or the effective risk, down to $0. So the rest of the trade past that point is entirely risk-free, and you have taken risk off of the table. And you can do that for various levels. So if you're selling 1/3, you'd be looking at 106, which is 1, 2, 3, and then 1/4, which is 1, 2, 3, 4. So there's various different levels that you can use for that. And so if we were going to look at this on a real chart basis, on TradingView, you can use the Fibonacci or the fib retracement tool to plot these levels for you, which is what I use. So the settings that I use are going to be here. With 0 or the red is going to be your stop loss, 1 is your entry point, and then you have 2, 3, and 4 for your free rolling levels. So on a chart basis, if you entered on this candle here where this blue line is, and then your stop loss was at the low of that candle here, if you were riding this up and you decided to sell half of your position here at the 623 level, you would sell half of your position here, and then when your position, or when the price ultimately ended up going all the way back down and hitting your initial stop loss, you could stop out here and you would not lose any account equity balance. There would be no damage to your account done in this regard. So we'll break that down again. If you bought 10 shares at 622.63, which is this line here, and then your stop loss is 621.42 down here, you have a $6,200 value on your position, and you're risking $16 on this trade. Oops, this should say 5. So if you're selling 5 shares of your 10 at 623.84 up here at this half free roll level, you have a $3,100 value, and then you have $8 of risk and $8 of profit. So you have effectively free rolled the trade, and so when this comes all the way back down, it means nothing. It just means that the trade almost never happened. It doesn't mean anything because you have risked $0. So the free roll level that I have the most success with is going to be the 1/2 sell. So what I typically will do is if I really only want to hold $1,000 of a position, I'll typically load up that initial buy with $2,000 in the expectation that I sell half of that as quickly as I can to mitigate all of the risk in the trade. Which is something that's been really sort of game changing in my trading, and it's been really cool to see, especially in the last couple of days, in the last couple of sessions, to see trades work out very quickly to where they are free rolled within the first like 5, 10, 15 minutes of me entering, and then I can just sit on my hands and let the trade play out. That's sort of an ideal position to be in. So if price is moving fast enough through that 1/2 sell point though, I will wait and then move a stop order to the 1/2 sell so that I can see if I use the 1/3. So if price is moving up here and we were moving up super quickly through this level, I wouldn't sell at the 1/2 sell yet. I would wait to see if we can come up to the 1/3 sell. And then if we don't, I'll just place a stop loss order here so that I would get filled on the way back down and it wouldn't matter. But obviously selling at the 1/3 sell is going to be the best in that case because you technically can hold a larger position for the same amount of risk. So as far as trailing stop goes, this is sort of a point from the last video. But so let's say if we were trailing stop here, let's say we bought on this candle here, this breakout, and we wanted to trail the 10-day moving average. We would trail this 10-day moving average, and we'd be looking for that first close under, which would be here. And this is where you would stop out at half or all of your position here. And then if you could do the same thing for the 21-day moving average, so this blue line, you could trail that up, and you would trail that first close under. This would be here. And so you really have to think about the time value and sort of how long you want to sit in a trade and the percentage gain for this. We'll go over some more statistics about this. So this is a point from Jack Corsellis' The Blueprint video. This will be linked in the description. This is a great, fucking phenomenal video. But I'll go over some of the important characteristics. I believe I have 3 screenshots throughout the slideshow. So this is looking at 60 perfect breakouts, and you can see that the 10-day EMA gain is going to be about 100, the 21 is about 150, and then the 50-day is about 200. But you can also see the time or the days in the trade that it took to achieve those gains. So you can look at how the time value varies between trailing the 50, between the 10, the 21, and the 50. So for me, I typically will always opt to trail the 10-day. I don't really care to sit in a trade till the 21-day moving average. I don't like to see positions lose value for consecutive days as they're setting up to base. So yeah, that first trail or that first close under that 10-day moving average, I'm typically out unless I think that the prior character of the stock has sort of let me know that it's going to be a stock that pulls back to its 21 and quickly rebounds off of that. Typically I'll sit, and as soon as we get that close under that 10-day, I'm out. And so a low of the day stop, which is that confusing definition we talked about at the beginning, this is going to look like something like this, where let's say that we bought on this candle here and had our stop loss at the low of the day. If we free rolled the trade in here as well, and then we were still up so much on this first day, when I'm looking at this, I wouldn't want to watch this go all the way back to the 10 EMA because I would be giving up so much profit in here. So it just is not an ideal way to go about that. If I want to lock in as much profit as I can, when we get super extended from this 10-day moving average, we're not even close to it, I'm going to opt for a low of the bar approach or a low of the day approach. So when we get this candle here and we are already 20, 30, 40% off of this moving average, I'm going to say I'm going to have my stop loss at the low of this day. So my stop would become the low of this day here, and then I would just trail this up every single day that it goes up. So my stop loss would move low of the day, low of the day, low of the day, low of the day, and then the first time I would be stopped out is going to be up here, which is going to be a little bit higher than if I had waited till that first close under the 10-day moving average. And sometimes this can be even more extreme. This is just one example that I could find very quickly, but this is going to be a very good approach in terms of if we get super extended, it's going to be really hard to not want to just sell into that strength and not want to be like, okay, like it's up 50, it's up 100%, let me just sell all of it. But extended stocks can always become more extended. So I would say this low of the bar approach is going to help you be a little bit more objective about the trade and just let your stop loss decide, as Darvis like to say. So this is going to be really effective in that regard, and that's sort of something that I am going to opt for. Obviously, you would feel a little bit bad as you watch some of these other days in here, but then if you look at it overall and you let it play out, you did actually get out at a better spot than you did this day. So this is going to be one of the other screenshots for this. In terms of profit optimization, this is just something to be aware of. You need to be aware of the compounding effect of large gains. So sitting in trades is always going to be a good thing. If you can sit in trade that is working, like the best stocks are the ones that are moving up. You don't want to be selling your you want to be selling your losers very quickly, and you want to be holding on to your winners as long as you can. So you can see this in here where we're looking at the total return rate down at the bottom for these different scenarios. The situation with the highest return rate are going to be ones that have big winners that sort of outweigh the rest of their winners or the rest of their losers. We can look at that more in detail here. But so the biggest winning example, this situation here got a return of 1,000%, and the reason that that happened is they didn't win. Their win rate was not any different. They didn't take any less trades. They didn't take their average losses were the same. The only things that were different were that they had higher winning rates in terms of the 100% gain, and they had two trades that were really, really, really good gains. So you can see like how the difference is when we start to skew these trades and just get a couple under our belt that are really, really big gains. That's where that compounding effect of the swing trading really comes into play. If you can catch one or two stocks that really blows up your account for the upside, that's going to be really helpful and let you put more money into trades going forward, and it's really going to help you sort of compound and just grow this account very, very quickly. That's sort of it for this video. I don't have a ton of other things to say about profit optimization. We'll get more into, when we talk about entries and exits and selling guidelines, stuff will get a little bit more specific in that regard. But as far as profit optimization goes, just be aware of how great that compounding effect can be. It's really, really important to think about that the majority of your profit and the majority of the really big trades are going to make up the majority of your account balance. So you need to be comfortable sitting in trades and sitting for those big runs because you never know when it's going to end. There's no point in selling preemptively, and you need to have very concrete selling guidelines and selling rules so that you don't just dump a stock off of your portfolio when it could have gone up 100, 200, 300 more percent and really grown that account to an unfathomable level. And then as far as free rolling goes, just I would say that you need to be mindful of it, but it's also something that like I utilize it in every single trade. There's not a single trade that I take that I don't free roll at some point. As quickly as I can, I'm trying to get risk off of the table. I don't want to have stocks that I'm holding and sitting on that are actively have the potential to lose me money. It might look like it's losing me money when value goes down, but in general, I don't want to have stocks that I'm taking a big hit on. So that's where that 1/2 sell comes into place. I'm trying to get that out of the way as quickly as I can, and then just move on. And I don't have to think about it because I know that even if the trade doesn't work out, I'm still going to be okay in terms of my account equity and my account balance. It's something that's really important to me. So like I said, that's really the end of this video. I believe the next video is going to be a little bit very detailed. We're going to talk about all of my entries, and it's sort of the video that I've been really looking forward to. So that's going to be exciting. I hope you guys enjoyed. Thanks for watching.